All right, let's talk about a company that's probably sitting in your living room or maybe your kitchen right now. I'm talking about LG. You know them. The TV, the fridge, the washing machine, their products are everywhere. But we're not here to review their latest gadget. Nope. Today we're digging into something much bigger. Their plan to go public with a massive IPO.
Yep, you heard that right. The brand you see every single day is about to hit the stock market. And what's really cool about this whole process is that when a company decides to do this, they have to lay out all their business details for the world to see in one giant official document. And that's exactly what we're going to break down.
So, what does it actually take for a giant like this to go public? Well, it's a huge undertaking. We're talking about hundreds and hundreds of pages of financial data, legal stuff, the whole 9 yards. So we're going to use LG India's own filing as a kind of roadmap to show you, as a potential investor, should be looking for in any company's debut. Okay, so here's our game plan. First, we'll look at the most important document in this whole process. Then, we'll figure out what the actual deal is. We'll peek under the hood of the business itself, run a quick financial health check, learn how to spot the red flags, and finally, see how you could actually get involved. Ready? Let's get into it.
So, first things first. Where does a journey like this even begin for a company? Well, it all kicks off with one very, very important document.
And that document is called the DRHP. That stands for Draft Red Herring Prospectus. You can basically think of it as the company's official biography, written specifically for anyone thinking about investing. And this is key. Every single thing we're talking about today, every number, every fact, comes straight from this document. It is the source of truth.
All right, so the paperwork's filed, but what's the actual deal here? Who is selling what, and for what reason? Let's decode the offer.
An IPO, an initial public offering, is that big moment when a private company finally opens its doors and says, "Okay, world, you can now own a piece of us." For LG India, this is their grand entrance onto the stock market stage.
So what's actually up for grabs? Well, the parent company, LG Electronics, which is based out of South Korea, is putting up to 101.8 million of its shares in the Indian business on the block.
But here's a little detail from that prospectus that really makes you stop and think. The average price the parent company paid for each of these shares way back when, just 1 rupee and 66 paisite. It's kind of mind-blowing when you think about the value they've created over all these years.
Now, this is a really important distinction you have to understand. This is what's known as an offer for sale. What that means is that all the money raised from selling these shares, it doesn't go to LG India to build new factories or launch new products. Nope. It goes straight to the parent company in South Korea. Okay, so we know what's being sold, but what is the actual business behind the stock? What does LG India really do? And more importantly, are they any good at it?
Well, according to a report they included right in their filing, they're not just good, they're dominant. This report says LG India is the #1 player in home appliances and consumer electronics. In fact, they've been the top dog in offline sales for 13 years straight. That is a pretty strong track record.
Their business is basically broken into a few main chunks. You've got your home appliances and air solutions, so think fridges and ACs. Then there's home entertainment, your TVs and soundbars. And what you might not know is they also make critical parts themselves, like compressors. And they have this huge after-sales service network to back it all up.
And when I say huge, I mean, just look at this number. As of June this year, they had more than 36,000 places where customers can interact with them. That is an absolutely massive footprint, reaching pretty much everywhere in India.
Okay, a big market share is one thing, but what do the books look like? It's time for a quick financial health check. Well, the first thing you notice is their revenue, and it's been on a really nice upward climb. It went from around 170 billion rupees a couple of years ago to over 213 billion this past fiscal year. That's exactly the kind of steady, predictable growth that tends to get investors interested.
So let's zoom in on this last year. They pulled in over 213 billion in revenue and turned that into more than 15 billion in profit. But here's the kicker. The detail from their financials that really stands out. Total borrowings? A big fat zero. This company is completely debt-free. All right, so far so good, right? Strong market position, growing revenue, no debt. But hold on. Every single investment comes with risks, and companies are legally required to spell them out in, well, sometimes painful detail. So let's talk about the red flags.
And they don't mince words. This quote is pulled directly from their document. Now, it's standard legal language, sure, but it's also a pretty stark reminder. They have to tell you that you could lose all of it, every single rupee. And that's a risk you absolutely have to be comfortable with before you even think about investing.
The list of risks goes on for pages, but some of the big ones they point out are things you'd expect: really tough competition, the fact they rely heavily on other LG Group companies for parts, and how their sales can be seasonal. Everyone buys ACs in the summer. But they also highlight something specific called contingent liabilities.
And that brings us to this number. So what are contingent liabilities? Basically, they're potential bills. Think of them as ongoing legal or tax disputes where, if the company loses, they'll have to pay up. And as of June, that potential bill stood at over 26 billion rupees. It's not a debt yet, but if things go south in court, it could definitely become one. Okay, so you've done your homework. You've read about the business, you've checked the financials, you've weighed the risks. If you decide you want in, what does the actual process look like?
It's actually pretty straightforward. First, a bidding window opens for a few days. That's your chance to put in an application. The money for your bid gets blocked in your bank account. It doesn't actually leave. Then, once the window closes, they figure out who gets shares. If you get an allotment, the money is taken. If not, the block is just removed. And then finally, the shares hit the stock exchange and trading officially begins.
And all of this really leads to one final big question. When a household name like this goes public, especially when it's the original owner selling their shares, who is this opportunity really for? Is it for you, the everyday investor, to get a piece of a great business? Or is it for the parent company to cash in after decades of hard work? The truth, as always, is probably somewhere in the middle. Something to think about. Thanks for joining me.